Give you a very big picture. It's very important to understand that all of this is going to apply. But it may not apply right now. And think of this as a layered approach of learning. We're layering information that's going to increase your investment knowledge today and going forward. Okay, so let's get started. Tonight we're talking about the wise investor. I want you to be the wise investor, the person who knows exactly where to go and what to invest in to grow your money over time. So the first place I like to start is why. Why should we invest our money? Well, goals. Meeting your goals would be one reason. Buying a home, retirement, maybe sending a child off to college. Those are big goals. That would be one reason. 3 reasons why we would invest. The real return of your money. Real return is the nominal return. That number you're going to see, let's say in a bank. Bank's giving you 0.1%. That's the nominal return. The real return is after you take in inflation. So an example is 0.1 plus an inflation rate of 3%, you would have a negative 2.9% real return on your money. So we invest our money to get a positive real return after inflation. That's a big deal. We strive to get a positive return after inflation, which is a real return. Growth. We want to grow our money. If it's sitting in the bank, it is shrinking. We talked about that last week. So we invest our money to grow it over time, to grow our wealth. And finally, freedom. And this is my favorite. You invest your money so one day you have the freedom not to work and to do maybe the things and the passions that are important to you. Investing provides you the freedom to live the life of your dreams, which is a pretty big deal. So where do you go? Edward Jones? I'm sure people have heard that name. No. Merrill Lynch? I'm sure you've seen that name on television. No. Morgan Stanley? No. Stock trade? No. American? No. Fidelity? No. Vanguard? Yes. And I'll explain tonight why. You see, what's really important is not so much figuring out where to invest your money, but figuring out where not to. The vast majority of places are where you should not invest your money. The vast majority of places are designed to take a chunk of your money and then invest the rest. And you'll get what's left. I'm going to send you to Vanguard so you can keep the biggest chunk for you. And I'll show you some numbers later that will bear that out. Wise choices. I want you to invest in no-load index mutual funds. That's it. That's the only place I invest my money. No-load index mutual funds. You don't have to have those things figured out yet, but in real simple terms, no load, meaning no commission. A load is a commission. And a mutual fund is simply a diversified pool of individual stocks and bonds maybe, where you buy into this pool and you become a part owner. And within that pool, you may own hundreds, if not thousands, of individual stocks or bonds. So you're buying into that at the cheapest possible cost because it's going to be an index fund. An index fund is a mutual fund that tracks an index, and we have no smart people trying to buy and sell, trying to outsmart the next guy or the next girl or a committee. And because of that, the costs are incredibly small, which you'll see a little bit later in the presentation. You can also look at real estate. Real estate can be a pretty good investment for some people. But you better know what you're doing. A lot of people that filed bankruptcy investing in real estate. So real estate isn't just wonderful because somebody tells you it is. You have to become an educated real estate investor. And when I say real estate, I'm talking about commercial real estate or single property homes that provide you income. A good investment, an investment period, provides income. So that takes out your personal home. Your personal home is not an investment. When you account for all of the expenses, the maintenance, your upgrades, your insurance, your property taxes, your personal home is a place that you purchase to live in and to enjoy, not as an investment. And that's, again, something we'll talk about in more detail when we get into the buying the home. So you see, that's a very small little block there. Did you have a question?
Yeah, so does that mean that real estate is not a wise choice?
No, real estate can be,
okay.
But I put the disclosure on there. It can also cripple you.
Okay.
Right? You want to become very educated and you want to be very careful because, again, the majority of people out there who are trying to get you to invest in real estate, they're not looking out for you. They got get-rich-quick schemes that help sell their books, help sell them, and so they make a lot of money at your expense.
So the no-load index mutual funds then are less of a risk?
Very much so, and I'll explain that a little bit later.
Okay.
Okay? And they require much less of you as far as knowledge. In other words, to become a real estate investor, you need to know a great deal about what you're doing. No-load index mutual funds, they're boring and very, very easy once you learn and understand them. Did you have a question?
It's true, you do need to be very careful in what you purchase for real estate, but I was just telling Glenda, where else can you put 20% down on a house, on a single family dwelling, and somebody else pays it for you, somebody else pays it off for you? Your tenant.
Mm-hmm.
Your tenant.
And that would be, again, an investment because you're providing income on that investment. The key is, what we always look at is, what is our return after cost? And that's what we'll be talking about tonight. So, small block. Now the big block, right, of what not to do. A lot of what not to do. Individual stocks. No, please stay away from individual stocks. I have invested in individual stocks. As I started to learn about investing, I thought I was so smart and I could pick them and pick the winners and avoid the losers. No, I couldn't. Research tells us you can't. And we tend to forget about those commissions and the taxes we pay as we're trying to outguess the next guy. Because again, when we're talking about investing in individual stocks, what you're doing is you're saying, I can beat the vast majority of experts. Because roughly 90% of the time, you're investing, you're buying an individual stock from an expert, somebody who does this for a living 24/7. 90% of the time. So what does that mean? Who knows LeBron James? Yeah? Professional basketball player, a really good guy. A really good basketball player, and he's really big. That is like you challenging LeBron James to a basketball contest, one-on-one. Do you really think you're going to beat LeBron James? I don't think so. And I'm not going to beat him either. So don't challenge him. Do not invest in individual stocks. You will lose. Next up, commodities. This is, again, something people love to invest in. Of course, it's not really an investment, it's speculation. Commodities, gold, silver would be two very good examples. First of all, they're not investments. They produce no income. All you're doing when you buy a commodity is saying, I'm going to buy it now because I think some sucker's going to pay more for it later. Stay away from commodities. Commodities are sold through fear and through greed. You can get rich fast, and the world's coming to an end. Stay away from that kind of thinking. That's how commodities are sold. They go up fast, and they go down fast. Life insurance. We talked about that briefly a couple weeks back. Life insurance is a terrible investment. Terrible. Cash value policies like whole life, traditional, variable. The life insurance agent will tell you how amazing they are, but they're not going to express to you all those commissions and fees that are going to eat up most, if not all, of your return, especially in the first decade. Stay away from life insurance when it comes to investing. Low mutual funds. Stay away from them. Commission mutual funds, right? Low equals commission. Which is again why we need to avoid financial advisors. You go to those financial advisors, you say, hey, Finley told me to buy a no-load index mutual fund. Well, they're going to steer you right away. Why? Because they make no money on no-load index mutual funds. They make nothing. They don't sell them. So they're not going to be recommending it to you, I promise you that. They're going to be pushing you towards load mutual funds. Commissions that you pay them, and then your money goes to the stock market. ETFs. In theory, there's nothing wrong with ETFs. ETF is an exchange-traded fund. It's kind of like a no-load index mutual fund that's traded on the stock market as if it was a no-load index mutual fund. It was an individual stock. Very cheap. And if you were to buy one that was diversified, let's say through the whole U.S. market, and hold it for 30 years, that would be okay. Except people don't do that. They buy them and sell them on a daily basis sometimes. And they treat them like individual stocks as they try to outguess and outmaneuver the next guy, LeBron James. So stay away from ETFs, not because they're so terrible, but because they cause you to have the wrong behaviors when you're looking at investing. Investing is a long-term horizon. We always have to remember that. We invest today for 10, 20, 30 years down the road. Not for what happens in the next week or next month or even the next year. No load managed mutual funds. Well, that sounds pretty close to what Finley's talking about, but it's not the same. Managed mutual fund is again a person, man or woman, or maybe a committee. They're buying and selling. They're very smart people, but they're buying and selling against other very smart people. And because of all that buying and selling, their fees go up. Even though it's a no load, it's no commission, fees are how a mutual fund makes money. Commissions are how a salesman makes money. Stay away from these, and I'll show you why. And again, before I get off that topic, it's almost counterintuitive to think you should avoid them. You would think, okay, I'm going to give my money to the expert versus an index where there is no expert. But I'm going to show you again why that's a mistake. So I'm going to show you research, academic research, that tells us where we should invest our money and where we shouldn't. So the key is focusing on the research, what we know versus what a salesman is going to tell us. They're not the same thing. Yes, ma'am?
And just to clarify, so we need to put the 20% that is our savings into investments?
That is correct. And you would be, when you first get started in life, you're looking at feeding that emergency account, and then feeding your company retirement plan at your work, and then feeding your Roth IRA. Both that company retirement plan and the Roth IRA we'll be talking about next week in investing in retirement accounts.
Okay, so we're not investing right now.
No, I'm giving you this big picture of kind of how investing works a little bit. And I'm throwing a lot at you.
Yeah.
Yes, sir?
So, your company taking away from your pay to put into your 401k, would that be a part of your 20% savings? Or
That is correct. And I want you to be looking for an index mutual fund in that 401k. Something we'll be talking about next week. Okay? Finally, other. I promise you. I see the future. They're going to be coming up with more products to get you to invest in, to get you away from those no-load index mutual funds that are boring. They're going to have products that are better. I promise you. I'm a psychic. I see this. Because they continue to find products that are going to make the financial industry more money. No-load index mutual funds don't make them very much money, which again you'll see tonight. So be prepared for that. It's coming, folks. Yes, Glenn?
Wait, I'm guessing that annuities are in the not so wise choice, but you didn't put it down there specifically.
I know. It falls under life insurance, but Glenn is exactly right. Annuities they're worse, in my opinion, than life insurance, right? But they fall under the life insurance umbrella. Annuities are sold through brokers, right? So the key here is, if we avoid life insurance agents and we avoid financial advisors, we will avoid annuities and all the crap that they sell that make them a lot of money and you not so much. So again, this is why I want you to be your own financial advisor. You can do it. You're quite capable. So on that other, be prepared. There's going to be something down the road. Someone's going to tell you, oh yeah, this is so much better. I'm showing you tonight how to accumulate wealth over time. I'm showing you. Take it, run with it, feed your accounts on a consistent basis. You'll see the difference over time. Next up, the experts, right? The investment broker, I've talked about him a little bit, life insurance agent, the banker. A lot of banks now are getting into the investment business. You got a bank that has savings accounts, and then you have a bank that has investment accounts. They're not the same thing. They're into the investment business. Why do you think that is? A lot of money in the investment business. So more banks and credit unions are getting into the investment business. No, again, commissions. You're going to be paying commissions to those experts. Financial advisor, same thing. Paying commissions. Financial planner, it's kind of a tweener here. There are fee-based financial planners and fee-only. Big difference between the two. Fee-based, they're going to be making money off of maybe working on your account based on how much money you have, and commissions. Fee-only is just managing your money, and they're looking out for you. That sounds pretty good. The problem is fee-only advisors, planners, they generally don't talk to people with less than, say, $500,000 to invest. Does anybody in here have $500,000? No, I didn't think so. See, there's not much of a system in America that's looking out for the little guy, for us. So we have to learn to do it for ourselves. That's what this message is about, doing it for yourself. Again, you can do it, and I will help you. So it comes down to you. You are it. You are the answer. And again, this is a layered approach. I know much of this stuff is kind of new and weird and strange, but as you layer it, one step at a time, pretty soon this becomes more familiar, and it's not so strange. And it doesn't seem as if it's some foreign language. But it takes time. It just takes time. But we have to make this commitment because we want a financially free future. And I'm going to show you how to do that and achieve that. Cost. Again, we do not want to pay commissions. Do not. Right? Commissions generally come in Class A, Class B, and Class C shares. So what does that mean? Class A share would be right from the beginning. A normal Class A share is 5.75%. So, you give them $1,000, they take 5.75 right off the top, the salesman does, that financial advisor, that life insurance agent, and then what's left goes to the investment company. You don't have to do that. You shouldn't do that. You can't afford to do that. Because guess what? You got to earn money just to get back to zero. Anybody want to guess what 5.75 plus 6.2 is? It's zero. You have to earn 6.2% after that 5.75 commission was taken out to get back to zero. Why would you ever do that when you don't have to? Those no-load index mutual funds, you pass the salesman and you give $1,000 to the investment company. And it starts working for you immediately with no commissions. Class B shares, also called rear-end shares, aptly named, I would say. They kind of nail you in the end. They get you with the money coming out. So Class A is in the front, Class B is in the rear, Class C is while you own those mutual funds. And that can be actually the most expensive over time. Class A, Class B, Class C, the name of the game, how much money can we pull out of you, the individual investor? So tonight, in many ways, I'm trying to teach you how to protect yourself and keep the vast majority of your money. It's not easy, folks. But the answer is education. Raising that financial IQ to become that wise investor. Fees are how a mutual fund makes money. An expense ratio.
Are all the classes the same percent of your?
No, they're not. They're going to vary from salesman to salesman. 5.75 tends to be the highest nowadays. It used to be in the 8s.
Wow.
Why?
I said, wow.
Yeah, wow. I say wow at 5.75, but yeah, wow. Yes, sir.
Don't people realize that they're almost never making it back to even? Because 6.2,
Let's,
a pretty good year.
yeah, you're exactly right. Let's take me, right? I was one of those suckers who started investing with a low fund. I didn't know any better. I thought that's how you did it, right? I went to the expert with the suit and the tie because I thought that's how you did it. This is what happens. You don't know what you don't know. You know something right now that more than half of America doesn't even know, i.e. the value of financial literacy. So your comment is exactly right, but that only applies if you know better. Okay? So the fees are how an investment company like Vanguard makes their money. So what we want to do is find a way to reduce those fees to the very smallest amount, which again I'm going to show you tonight. And again, it's those no-load index mutual funds. Turnover, this is what happens with managed mutual funds, as well as other mutual funds. Turnover is they're buying and selling, incurring more taxes, more cost that in the end you pay for. Taxes, same thing. The more times you buy and sell, the more taxes that investment company is going to pay, and you indirectly, and then finally, in the end of the day, you pay for it. We want to reduce those costs. So, I want to talk about 4 pillars of investing. I would encourage you to look at these 2 wonderful investment books. The first one, this is for kind of a beginner, the little book of Common Sense Investing by John Bogle. It is a wonderful book. As you see, not very big. It's a good way to get started. This is the man who started Vanguard. And he'll teach you more than most people could teach you in a lifetime. Yes, sir.
Why would he be pushing all the loaded and managed mutual funds if
He's a teacher. That's why, right? We talked about this before. He's a teacher. He's looking out for you. Just like that's why I'm here tonight. I am trying to help you. I don't really care about these companies. I don't really care about Vanguard.
I mean, he's going to make less money by educating us, though.
That is correct. It's not about money. That's the point. Right? He's an educator. He's a teacher. It's not about money. I know. You think, but dude, we're talking about investing. It's not about money. It's about advocating for you as an individual to make the best choices that are going to serve your needs long into the future. Teacher. And then, second book, my favorite investing book of all time, The 4 Pillars of Investing by William Bernstein. Love it. It's a little bit bigger. It's not necessarily for beginners. I would buy it. I would read it. I would read it again. I'd read it again. We're going to be talking briefly about his 4 pillars. He educates, again, he's an educator. He could care less about these companies. He is advocating for you to be the very best and wisest investor so you can grow your money over time. And the only way we're going to do that is we educate ourselves. We learn about the history of the markets, the theory behind investing, the psychology of how investing happens, and the business, the financial business. So, I'm going to briefly talk about these pillars. First, history. We got to know about the history of the markets. We have to understand bubbles. We have to understand why markets go up and why they collapse. We have to understand things like the tulip mania bubble. There was a time when people sold their homes for 1 tulip. You think to yourself, well, that is insane. Google tulip mania. You'll see insanity. But, yeah, maybe, you think to yourself, that's insane. But what about the dot-com bubble? Anybody familiar with that? Yeah, that was in the late 90s. When we look back now, we think, well, that was insane. Well, there were people trading all over America before it collapsed. The housing bubble. People were saying, houses are going to go up, up, up. And then it collapsed. Bubbles occur throughout our history. By educating ourselves and understanding the history of speculation in the markets, we will become more informed so we don't fall into that trap. But you have to know the history to avoid those kind of mistakes. It's imperative. Gold and silver, I would give you an example. That's the bubble. That's the bubble we're in right now. You have to be able to see this stuff. How do I know it's a bubble? Notice how many commercials you see on buying gold and how that's ramped up over the last few years. In other words, you can almost watch the media. You don't even have to be an investor in that particular security. You can simply watch things. By understanding the history of the markets, you start to see how things start to become crazy. If you can learn to actually see those things before they happen, you are way ahead of the crowd. And that leads us into psychology. We have to try, and this is hard, we have to try to take our emotion out of our investing decision making. I said it should be easy, but it's not. People use emotion all the time. They see the market go down, they sell. They see it go up, they buy. Right? We have to avoid that kind of thinking. That will not serve you well. What I want you to do is identify the right no-load index mutual funds, feed those funds every month through dollar cost averaging, ignore the gyrations of the market on a day-to-day, month-to-month basis, and fit it towards your plans, your financial goals, your time horizon, your risk tolerance. We have to be very careful of a thing called recency bias. Recency bias. Let's go back to gold. Over the last decade, gold has done very well. Averaged roughly 18% a year. And you're thinking, wow, 18%, I'm buying gold. Well, you just fell for recency bias. You looked at the last decade instead of looking at the last multiple decades. In other words, recency bias is only looking at what just happened, not what that kind of investment has earned over a lifetime. And what you see is reversion to the mean happening. Reversion to the mean is when something comes back to its average at some point. Gold averaged around 18% a year the last decade, but its historical averages are roughly maybe 4%. 18.4. Reversion to the mean tells us they're going to come back. And that's when bubbles pop. So that's why we have to be very careful to avoid recency bias. And we look at the historical averages of an investment before we invest in it. It's imperative that we understand reversion to the mean. What does that security actually earn over time? And what has it done recently? And if you're letting something that happened recently affect your decision making, you need to step back. Again, try to do the best you can to take emotion out of your decision making. Make rational decisions based on what is best for you for a long period of time. Finally, Occam's razor. Anybody familiar with Occam's razor? Few people? Yes, right? When we're provided a couple of different options, or 4 or 5, Occam's razor says, let's pick the one with the fewest moving parts, the simplest approach. The one that provides us the simplest answer versus the more complicated one that takes all kinds of, different charting. Well, Occam's razor tells us no load index mutual funds. I keep saying that. I want to plant that in your head. I don't want you to forget that. And by the end of tonight, I hope you see why. Modern portfolio theory. This is just basically, in simple terms, we look at our portfolio as one. So we may have a company retirement plan, we may have an emergency savings, we may have a Roth IRA, we may have real estate. We don't look at each one of them in any condition year and say, oh, well, that went down, so I'm selling it. I'm going to buy this that went up. No, modern portfolio theory says we look at all of it, we put it together. It's our asset allocation. We allocate our money to fit our time horizon, our risk tolerance. When I say risk tolerance, that means what would cause you to freak out and sell everything. And then our goals. What are our goals? What are we investing for? And that will include stocks, bonds, cash, and possibly real estate. So modern portfolio theory helps us understand investing and understand how we allocate our investments. And again, all of this can be done with no-load index mutual funds. So, now let's show you a little technology, and I think you'll be interested. If I could get some help with the lights back there, please. talking about a crazy way of thinking. This is all about advocating for you, the individual. Take a moment and read that. That is in line with everything I've been saying over this hour. She is a teacher. I trust her. You can trust her. Research. This is research over the last 15 years, running from 97 to 2011. What those numbers represent, is how many managed mutual funds failed to beat an index. Failed to beat the index. So those stock funds, 84, 96, 95, bonds, the average of all of those funds was 87%. 87% over that period of time failed to beat an index. So all those smart people were just trying to outfox each other, and they were failing. And this number would be even higher if they included the dead bodies. You see, there's a thing called survivorship bias. And in mutual fund land, many mutual funds, they die because they have poor management and they just get buried. Except, unlike humans, in the mutual fund world, they act like they never existed. So those numbers would be even higher if they included the dead bodies. Again, managed mutual funds have a terrible record of beating no-load index mutual funds. Now I'm going to take you to the Vanguard site, something we're going to review in the second hour tonight in more detail. But I want to show you a few things. This is an asset allocation model. This shows if you had a certain amount of assets in bonds and cash versus stocks, what your historical return would have been. So for an example, if you had 100% of your investments in bonds over this 86-year period from 1926 to 2011, you would have averaged 5.6%. Again, every year is going to be different, but that was the historical average on a per-year basis. The best year, you would have made 32%. Worst year, you would have lost 8%. 13 out of the 86 years, you would have had a loss in your total return. Now that's 100% bonds, no stocks whatsoever. As we go up, we start to see the average return go up because of stocks, but we also see other numbers going up or down. So let's take a look at a 60% bonds and 40% stocks. Average return, 7.8. Better return, but the best year went up to 27.9. Worst year, you lost 18%. So, as we invest in stocks, we have to be willing to accept more negative years. They will happen. If we're going to expect higher returns, we must accept higher risk. But that risk is in the short term. As we continue to go up, I'd like to take you now to an asset allocation that I would recommend for most of you based off your age, which is 20% bonds and 80% stocks. Now, why do I recommend that? Well, it goes back to what John Bogle would tell us. As a general rule, have your age in bonds and cash. So if you're 20, you would have 20% of your asset allocation in bonds and cash. If you're 40 years old, you would have 40% of your allocation in bonds and cash. If you're 60 years old, you'd have 60% in bonds and cash. Now that's a fairly conservative approach, but as John Bogle will tell you, most people are not as risk averse as they say they are. Yes, sir.
Can I just point out that the worst year is always like in 1931 because that's when the Great Depression happened.
That's right.
Like say if this were like from 1945 to 2011, I bet these numbers would be way better too.
They would, but it's also a reminder that, as they say, on occasion, the stock market goes haywire. It goes crazy, and you're going to have a bad year. And something I've spoken to you before, I guarantee you, if you invest in stocks, you will lose money in some given years. That is a guarantee. You have to accept that. If you can't accept that, you should never invest in the stock market. If anybody tells you that you can invest in the stock market risk-free, they're either lying to you or they're totally ignorant of what they're telling you. So, let's take a look at that 80-20 split. Average return, 9.4%. Not bad. Best year, 45%. But worst year, as you noted, lost 35%. That hurts. And 23 out of the 86 years, you lost money. That's roughly 26% of the time. Or 74% of the time, you made money as the stock market went up. Guess what?
And I missed the regrets part last week. So just because most of you are so young, you'll be able to stick with that age, have it in stocks, or age, have it in bonds. I'm playing catch up because we started late. So right now we are riskier than I would like to be based on our ages because we have a lot of making up to do. Don't be us.
So the word there is to get started early and stay with it?
That's right.
Okay. Good advice. Good advice. Oh, sorry. I have another thing to show you of anger. This is where I want to show you insights. Again, this is the Vanguard.com site. You can go to Investing Truths. Truth about cost. Here I'm going to select a return at roughly 9.4%. I know it's blocking you out of that a little bit. If we go to an expense ratio of roughly 3% a year, this is the equivalent of going to an advisor, a financial advisor, or life insurance agent, and paying those commissions. What you're going to see here, the color in dark is the amount of money you keep from a $10,000 investment. The color in white is what you give up in expenses. Let's see what happens when you go to a financial advisor. So what does that mean? First year, they're getting roughly 30% of your profit. Yes, Amy?
I thought it was 5.75.
Well, correct. We're taking that 3% and we're trying to equate it over a longer period of time. So in other words, you're right. It could be worse.
Okay.
I'm being rather kind.
Okay.
5 years. Note here, you're doing all the risk taking. This is your money, and that stuff in white is the money you're giving to the financial industry for simply serving as a middleman. Year 25, they're getting more money than you are. and you're taking all the risk. 50 years, you see all the white. I'll have a diagram to show you that in detail. Now let's take a look at what you pay for a managed, no-load mutual fund. So you've reduced the commissions, but you're still paying pretty high fees. 1.5% is an industry norm for many managed mutual funds. So you're keeping more of the money, right? You see a lot more dark. But still, after 50 years, they get more money than you do. And again, you're taking all the risk. If you invest in a no-load index mutual fund, I promise you, you can get your expenses low. As low as 0.11. Watch as you keep your money. I think you can let the illustration tell the tale. You can barely see the white now, folks. This is why we invest in no-load index mutual funds. You keep your money. In the financial industry, they get a very small bit. What they deserve, because you're doing the risk-taking, not them. Key there, asset allocation matters and cost matter.
I got a question. When you were at the previous one we were talking, you had stuff about the balanced portfolio and aggressive portfolio. From my understanding, that's kind of where my background is. So how does that apply to me when I apply for, say, an aggressive portfolio? Am I not applying for an aggressive portfolio, I'm applying for a no-load mutual? Can you kind of explain maybe where I'm getting confused on?
Okay, what exactly is the question?
So, how I've been introduced to different sections like that is 80% stocks, 20% bonds and whatnot. That's your risk factor. And according to your risk factor, that's how a company or one of these guys would try to put you into that different categories.
Right. I want you to do that, and I'll show you and help you through that process. You could simply take a total stock market index fund and place 80% of your investments in that fund. And then you can take a short-term bond index fund and place 20% of your investments in that, and voila, you're at 80-20. And it involved two mutual funds, both no-load index mutual funds. So this process does not have to be complicated. And don't let people think it is. It is not. Many experts want you to believe this is complicated, so you will come to them. And now let's take a look at these numbers. These numbers are after 50 years. This is the last bar on that chart. Those loads, you would have paid $689,000 after 50 years. You would have capped 193. Think about that, folks. The managed mutual funds, they did better, but they still took more than half of your money. What did they do to earn it? And finally, the index. Look how much you kept and how much they kept. this is an example of a few stock funds. Over time, you can allocate your money towards these type of stock funds, all at Vanguard, all index funds. These are issues we can talk about in the second hour as you like. These are bond index funds. And then that third bullet, you simply rebalance your account on a yearly or maybe semi or every third year time period, where you go back to an 80-20 allocation, because over time, your investments are going to get a little bit out of whack. Stock market goes up, you may end up with an 85-15 split. The bond market goes up, you may end up with a 70-30 split. And so you simply rebalance by selling some, buying another to get back to your 80-20 allocation. I'm going to show you a few experts what they have to say. David Swenson was the Chief Investment Officer of the multi-billion-dollar Yale University Endowment. Jack Meyer, former president of the Harvard Management Company, managing the multi-billion-dollar Harvard Endowment. John Bogle, we've talked about him tonight, received the Institutional Investors Lifetime Achievement Award. And finally, fourth man we'll bring in, a guy named Warren Buffett, named the top money manager of the 20th century. All of these gentlemen are behind this approach of investing with no-load index mutual funds. So that's information. You can see more at my website, crazymanwithpinkwig.com. It's a little crazy, some of the information you've heard tonight, but I just brought 4 of our friends along. And in the future, if someone is talking to you about doing something different with your money, ask yourself, do I listen to them? Or do I listen to Warren Buffett? Lights, please. Okay, folks, I've given you all that I know. That was a big picture idea. Investing wisely goes into our bag. Our journey continues. Remember, knowledge, knowing, and applying what you've learned, it'll help you for years and decades to come.